Picture a company that has just raised $100,000 capital and obtained $50,000 property, plant and equipment, or PPE, such as machinery. Congratulations! The company is now ready to operate. In this video, we will look at what happens to the financial statements when a company makes revenue. Note that when a company actually makes revenue, it either sells the products it bought from the supplier, or it sells the product it manufactured or produced. Either case, inventory and cost of goods sold will be impacted at the same time revenue is made. But for simplicity, we will only and purely look at revenue in isolation, in order to grasp its impact on financial statements. The first thing that happens when company makes revenue and receives cash, is revenue is booked in income statement. At the same time, the same amount of cash is booked as an asset. So the transaction is debit, cash $5,000, credit revenue $5,000. Now, we know that the left-hand side and the right-hand side of BS do not seem to equal. Aren't they supposed to equal? Of course they are, and this is how they equal. If we look at the BS and income statement combined, both left and right-hand side are equal, in this case $105,000 respectively. It is important to understand that debit side and credit side of BS and income statement collectively will always be equal. Easy to understand if we see the picture, but if we look BS in isolation, BS seems to be not equal. In order to bridge between BS and income statement, we use a plug. That plug is called net income for income statement, and retained earnings for BS. They equal to each other. Imagine net income and retained earnings as a plug that plugs the gap in BS and income statements, which will always be an equal amount. This income statement, BS linkage is very important. We will look at another revenue example. In this example, company makes revenue, but does not receive cash. It only gets the customer's promise to pay later. Such transaction is called credit sales, and instead of cash, the company books accounts receivables as an asset. Accounts receivables represents the customer's promise to deliver cash and consists of assets because it will bring cash to the company. This transaction will be recorded by debit accounts receivables $5,000 and credit revenue $5,000. Again, if we look at BS alone, debit and credit do not seem to be equal. We need a plug to fill in the gap between BS and income statement. Remember, looking BS and income statement combined, debit and credit will always be equal. First, income statement's net income increases to $10,000. As it does, BS retained earnings also increase. Therefore, functioning as plugs between BS and income statement.